And Xiaolin, let's start off with Country Garden and the stress that we are seeing continue to unfold amongst China's property developers. Will this default be managed or disorderly, and what is the risk that it spreads?
Thank you for having me, Good morning.
My pleasure.
It's a great question. It's definitely impacting market sentiments towards assessing China as a capital market, as an asset class to in clients' portfolios today. Is real estate sector happening in China? We certainly believe this will be a managed fashion in dealing with any issues in real estate sectors as the developer continue to restructuring its debt, as other real estate developer may come to light that they have to restructure their debt to deal with the debt situation they face. That being said, market has pressed in a lot of uncertainties with this kind of companies that get involved in real estate developing in China, that the project get heavily impacted, the new home sales get also severely impacted. In many of the market headline news happened domestically and externally. This is well broadcast issues happening in the sector, happening to those companies. So we certainly believe a lot of the downside risks these companies bring to the sector has been pressing in the market.
Is there an element of too big to fail, though, with Country Garden in terms of its systemic and economic profile and significance? And just explain to us, if you can, Xiaolin, how central Country Garden is to China's economy. And the problem that I have with the story is that could Country Garden end up, in fact, being worse than Evergrande, given Country Garden has 4 times the number of projects?
First of all, the market has, pressing a lot of the downside risks. We discussed that, but then Chinese policymaker had made sure that the properties that get sold, not finished, must be finished. So they are managing certain impact to the investors, certain impact to the household and Chinese retail investors that who bought the housing that they hasn't finished. They have to manage that downside risk or spillover risks from them not finishing the project. Yes, they are in a large scales of owning a project, owning the land, owning finishing the properties, but certainly they have had the time to manage the unfinished project, manage their exposure to deal with the downside risk with certain time given to the company itself and to the industry to de-risk, to deleverage, to manage their situation better than they could have been. In other words, I think the real estate sectors in China is going to continue to experience consolidation. It's not finished yet. We discussed this in the past on the sectors stages they are at. Is still at a consolidation stage. They're not finishing yet. If you see the new home sales in China as overall is still declining, the housing price is still declining. I think market is still trying to find that floor that they feel comfortable to stabilizing. A lot of policy introduced in China in terms of dealing with mortgage rates, in terms of dealing with encouraging the people who were not eligible to buy, who can now eligible to buy in the city they live in, certainly encourage investors to look at this sector, look at the new property developed or new property ready to sell, to encourage them to buy. But clearly that will take some time for the investors' confidence to return to the market to start to see some more buyings.
Xiaolin, I know your KraneShares and your ETFs, but just for the sake of argument, I know your take is that Country Garden, the situation may not be that bad because, like, let's say Sunak, it's not as though they're going to actually roll over and die. They are going to attempt to restructure their dollar debt like Sunak did. The only thing is, it takes a heck of a long time, especially when you have that many shareholders or bondholders, rather. And also, at the end of the day, you're probably going to get some money back, but not much. I want to get an idea, because that's what bond pricing is supposed to tell us. Country Garden Jan 24 bonds. At one stage, we're selling at 7 cents per piece of paper. A lot of people looked at that and said, hey, at 7 cents, it's worth the risk, because, if the thing doesn't go belly up and you hold it to maturity, which is only about 6 months away, you're looking at about 20x returns. The pricing right now is not 7 cents anymore. What is the pricing telling you about the likelihood of actual default?
The real estate markets, particularly in the bond market, particularly in high yield, we did see some of the fixed income investors did pick up on the stressed debt and basically get a very high yield, very attractive yield. I remember a year and a half ago when people discussed a very high attractive yield in China. Real estate markets is very attractive. They usually get 20% yield to the bonds at some stage, which I think you will pick up some good bonds at good pricing. And no doubt about that. But it's not for all the stomach.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to the channel for more. Thanks for watching.